A 177-year-old industrial giant is currently trying to outrun a global shift toward protectionism, all while simultaneously funding the most expensive technological pivot in its entire history. Siemens is facing a massive currency gravity problem. Even though they just posted a highly respectable 6% real growth, a persistently strong euro combined with mounting U.S. tariffs just entirely wiped out their nominal revenue gains. It's a high-wire act. They are balancing old-world manufacturing right against new-world artificial intelligence.
When you look at the top-line figures, you see the exact mechanics of this currency gravity at play. They generated that 6% growth on a comparable basis, yet the nominal growth sits at precisely 0%. Translation effects alone just stripped 6 percentage points directly from their revenue. It's exactly like running on a treadmill. You're putting in the physical work, you're generating operational momentum, but externally, you haven't moved a single inch. This flat headline forces investors to completely recalculate how they measure the company's true value, especially when external macroeconomic headwinds are completely masking internal growth.
The reaction to this volatility is an aggressive, dual-pronged allocation of capital. Right now, they're running a fresh €6 billion share buyback program, simultaneously with a massive $15 billion in M&A spending for software platforms like Altair and Dotmatics. This is not the signal of a company that simply has too much cash sitting around. It's a high-stakes game of simultaneous defense and offense. By shrinking the share count, they're fiercely defending the stock price against the typical conglomerate discount. But by acquiring high-margin simulation and life sciences software, they're going on the offensive, positioning the firm to become the actual operating system of the physical world. The foundational support that allows management to execute this aggressive strategy is a staggering $124 billion. That's their record order backlog. In a macroeconomic climate defined by geopolitical fog and constant supply chain uncertainty, a number this large acts as a hidden lighthouse. It completely alters the risk profile and investor psychology surrounding the organization. Instead of guessing at future demand or worrying about the next quarter's exact economic conditions, Siemens has over 18 months of guaranteed revenue visibility already locked in. Breaking down the quarter's consolidated metrics reveals exactly how this backlog translates into operational fuel. Group orders surged 18%, and free cash flow skyrocketed 70% year over year to hit €1.7 billion. Why does this specific jump matter so much? Because this baseline of surging cash generation provides the exact operational runway they need. They're actively funding a futuristic, wildly expensive digital transformation using the resilient, predictable cash flow of their traditional, old-school industrial business. That cash flow, however, is constantly under attack. In their mobility segment, we're seeing a severe 170 basis point margin squeeze. A recent U.S. Supreme Court ruling on tariff structures triggered an immediate, painful reassessment of project profits for rail freight and equipment. Protectionism isn't some theoretical risk debated by economists. It is a hard market variable that literally wiped out profit margins and forced a downgrade in the division's full-year revenue outlook to just 5 to 7%.
This intense pressure on margins is exactly why the move toward localized manufacturing isn't just an operational choice, it's a baseline survival mechanism. Call it the Lexington Gambit. To bypass the tariffs actively shrinking their profits, Siemens executed a brilliantly strategic chess move. They opened a $220 million, highly automated train manufacturing plant right in Lexington, North Carolina. By producing passenger coaches and locomotives directly on U.S. soil, they're effectively building a physical fortress against global trade volatility.
That squeeze on hardware margins also forces an offensive pivot toward high-margin software within their digital industries segment. We're looking at €1.6 billion in software revenue, running alongside €5.5 billion in annual recurring revenue. Shifting away from selling one-off physical machines to a software-as-a-service model provides deep revenue predictability. Escaping the trap of commoditized hardware through these software subscriptions creates a true flight to quality among institutional investors. Those investors heavily favor the financial safety of predictable, recurring revenue over the volatility of single hardware sales. The crown jewel of this software pivot is the Eigen agent. Let's be explicitly clear here. This is not a conversational chatbot. It is an autonomous AI system that can actually plan, execute, and validate industrial tasks directly within factory control systems. Right now, there's an acute global shortage of human engineers. Siemens isn't just selling a shiny new digital tool, they are selling a structural solution to that exact shortage. They're effectively selling automated human expertise. The pilot deployment metrics fundamentally shift the economics of factory automation.
execution speeds are 2 to 5 times faster, and solution quality increases by up to 80%. When a software agent can autonomously write complex machine code and configure factory hardware without human intervention, smaller teams can suddenly manage vastly more complex infrastructure projects. The traditional constraints of human labor bottlenecks are completely removed from the industrial growth equation. And the demand for that physical and digital infrastructure is exploding, driven directly by the AI boom itself. Smart infrastructure just captured a record $7.53 billion in orders, heavily fueled by U.S. data centers. Think of it as a brilliant, self-reinforcing loop. The AI boom creates a massive demand for Siemens physical grid hardware, things like heavy transformers and electrical grid tech. And once those massive data centers are powered by Siemens hardware, those hyperscale customers are effectively locked into the Siemens software ecosystem to manage it all. This dynamic forces us to map out realistic, data-backed, probabilistic scenarios for the market moving forward. Scenario 1 is what we can call the protectionist wall. The risk here is that US and European tariffs escalate beyond what localized manufacturing can offset. We would see real-time validation of this scenario if the mobility segment continues to suffer margin compression and further revenue downgrades. However, this threat is invalidated if the Lexington facility and similar localized manufacturing hubs successfully scale their automated efficiency, proving that localized production can be just as profitable as globalized supply chains.
Scenario 2 explores the upside, the digital re-rating. In this outcome, institutional investors stop valuing Siemens as a slow-moving industrial conglomerate and begin pricing it as a high-growth technology firm. Validation of this scenario requires sustained double-digit growth in their SaaS revenue, alongside successfully spinning off or deconsolidating non-core assets like Healthineers to streamline the overall business. On the flip side, this entire thesis would be invalidated if the massive integrations of Altera and Dotmatics result in corporate bloat rather than seamless digital synergies. Evaluating these incentives and future scenarios brings us to a core reality of the modern industrial age. The old Silicon Valley adage that software is eating the world has finally reached the factory floor. When a company founded back in 1847 is now the primary partner for NVIDIA to build industrial AI operating systems, it proves that technology is no longer an isolated sector. It's the core of everything physical. Siemens is no longer just building the machines of the industrial age, they're building the brains that will run the next one.
This leaves us with a critical tension moving forward. As localized supply chains definitively replace globalized trade, will the future belong to the companies that build the AI algorithms or the ones that control the physical machines they run on?
An investment in knowledge pays the best interest, so why not invest in this channel? Click like and subscribe for more.